I'm joined right now on set by John Lonski. How are you thinking about of this right now? Is this kind of a knee-jerk reaction, you think, from some investors?
At best, it's a knee-jerk reaction. It makes no sense to me. I don't think that these charges by themselves are reason for this sell-off. We have limited sell-off on the equity side.
Yeah, I agree with you. But fundamentally, let's talk about what's going on. The economy's improving, wages are growing, people are worried suddenly about inflation. You've told me you're not that concerned about inflation.
Well,
this is not the 1970s all over again.
No, it's not going to be the 1970s. My goodness. For one thing, we face a lot more global competition. The 1970s, when I was a young man entering the workforce, I was shielded from competition that kids nowadays face from people in China and people in India. That didn't exist. Even Russia didn't exist as a competitor.
And you're talking about this within the context of inflation, right?
Right,
because the thinking being, well, look, wages are going to go way up. The cost of everything is going to go way up. And you're saying it can't because there's too much competition.
Too much competition. We also have an aging economy. We're much older today than we were back in the 1970s. And quite frankly, companies could hike prices to high heaven. But in all likelihood, the consumer isn't as strong. The middle class isn't as strong as it was in the 70s and 80s. They can't afford the higher prices. So what does the consumer do? They stop spending. They cut back on real consumer spending. January's retail sales down 0.3%. Inflation was up 0.5%. That practically guarantees a reduction by real consumer spending in January. So much for talk of faster than 5% real GDP growth.
So what does it mean for rate hikes?
You're still going to get, if I was an investor, I think a prudent investor is looking for no more than 3 rate hikes, okay, in 2018. So you finish the year, Fed funds at 2.125%. But I will go a step further and project a 10-year Treasury yield that by year's end will be no higher than 2.75%, which is somewhat lower than it is right now.
All right, John Lonski. Thank you very much.
My pleasure.
I think I like the sound of that. That's it. I do like a little inflation. We could use it. We haven't had much.
But it's not going to go through the roof.
Good.
It's not going to be a replay of the disco inflation of the 70s. No way.